Today's video is going to go back to a format that we used to do. It's completely unscripted, so please forgive the ums and ahs. Before we begin, I want to remind you that I am not your financial advisor. I don't know your situation, so please do consult your own financial advisor before taking any investment action. Okay, so today we're going to talk about how do I know if I'm investing too aggressively, rather. What's the definition of aggression? In my opinion, you should define how aggressive your investments are based on the risk of loss. Now, I understand that reasonable people could disagree on that, and a lot of people look at also, when deciding how aggressive an investment is, they look at the potential for gain. But I really think that the best way to think about risk and aggression is how likely it is that you could lose your money. On a spectrum of risk, the investments fall as follows. I think that the most conservative, least aggressive investments are cash. And I do want to acknowledge that even cash, there's risk. So if you invested in the Argentine fiat currency, that's obviously going to have been a horrible investment. I'm talking about US dollars, greenbacks, and there is absolutely no investment that is completely free of risk, but relative to others, I think cash is the safest. Next would be bonds, followed by real estate. Getting into riskier investments, I would say, would be stocks and commodities. Getting into very risky investments with a higher potential for risk of loss would be cryptocurrencies, and then anything involving shorting or leverage. And just a note about leverage, if you lever, it could pertain to any of the investments that we've just talked about. So you could use leverage, borrow money to buy real estate. You could borrow money and go on margin to buy stocks. That exponentially increases your risk, potentially. Some considerations before I give you the framework on deciding whether your investing style is too risky. So the first thing I want to talk about is your goal. It's very important that you consider your goal, because the bigger your goal, the more potential risk and the more aggressively you'll probably need to invest. The next consideration is time frame. If you have a lot of time, like you've got 100 years to get from here to there, then you could probably be more conservative and less aggressive. But if you want to accomplish your goals in a short time frame, you're probably going to need to be more aggressive. And then the next three things I want to talk about are knowledge, skill, and temperament. And these are basically personal attributes. How knowledgeable you are about investing, what's your skill and experience, and whether you tend to panic in the face of a market decline. And for any given investment, your risk increases if you don't have knowledge, skill, and if you tend to panic. So to use myself as an example, I am very familiar with stocks. So compared to an amateur, I think my risk level, again, relative to an amateur, is lower. Okay, let's get into the framework. I want to preface this by saying that there will be some math involved, but don't freak out. What I'm going to do is provide you a conceptual framework, and you can either work with a financial planner on the specific math. You could look it up yourself, and it's totally doable on your own. Or if you want, you can contact me at eric.chung@lighthavencapital.com. I'm happy to help you or to send you a spreadsheet where I calculate the math when I'm doing my own financial planning. So the framework is as follows. First, I would start with your goal in dollars. And let's just use an example. Let's say that your goal is to get from $100,000, whatever, let's assume that's what you've saved, and you want to get up to $10 million, which is a lot. That's, 100-fold. So that's the first thing, to be really clear about your goal, and you want to write that down, put it in a spreadsheet. Secondly, you then want to be really clear with yourself about how much time you have to get there. So if you have 100 years to get there, which most of us don't, none of us have, you're going to be able to do that in a very methodical, conservative way. But if you want to get to your goal in, say, 20 or 30 years, you might have to utilize a more aggressive strategy. And what you want to do is, in a spreadsheet, map out kind of every year how you're going to progress based on where you're starting, in my example, $100,000, and your after-tax savings. So every year you're your $100,000 is going to grow based on how much money you save. Plus, it's going to be a function of your return on investment, right? So if you have $100,000 and historically you've been making 5% a year, then in year 2, you're going to have $105,000 from your investments plus whatever you save. Now, what you want to do then is project this, and in your spreadsheet, have a row for every year so that you can see that based on your assumed rate of return, whether you'll get to your goal. And I would recommend that you use what's called a compounded annualized growth rate. Again, don't freak out if you're not familiar with that term. That just simply means it's referring to your return on investment, and it's the rate of return that you compound every year. And what you're doing here is you are basically assessing how you're doing with your current strategy. Again, this is purely based on historical returns, and seeing whether you're going to hit your goal. Now, I would caution you that regardless of whatever your current rate of return is, you want to be careful about assuming that in the future you're going to be able to get that rate of return. So there needs to be a bit of a margin of safety. But what this will do for you is when you compare what you're doing and whether you'll get to your goal, is you'll see whether you're being aggressive enough or too aggressive. If, by doing this math, you will overshoot your goal and it looks like you're going to, with your savings, your tax planning, and how you're investing, you're going to exceed $10 million, maybe you should consider putting more of your money in conservative investments and being less aggressive. On the other hand, if it doesn't look like you're going to get to your goal, you might want to consider getting a little bit more aggressive. Now, this is a vast oversimplification. In this spreadsheet, you should, again, feel free to work with a financial planner so that you can make sure that you're capturing all the variables. But there's a bunch of things that you should consider. So we've talked about the investment performance. That's absolutely probably one of the biggest factors because it compounds over time. But taxes are a big factor. To the extent that you could reduce your taxes, you can get to your goal faster. Another big thing is increasing your savings. You can increase your savings by either increasing your income and or reducing your expenses. And that's also going to help you get to your goal faster. And if you can make more money or spend less, again, you can be less aggressive on your investments. Again, I didn't go into detail on the math. I appreciate that the math can be daunting, but don't freak out. Again, there's lots of resources out there, and you can contact me if you'd like some help. And just a plug for Lighthaven, if you do your planning and you would like some help with your stock portfolio, potentially improving the returns on your stocks, I would love for you to consider the Lighthaven Fund. Now, if you've enjoyed this video, please forward it to a couple of friends. Thanks very much.